Hi, good morning, everyone. So today we have one of our goats, greatest of all times here, Hedley Widdup. It's so great to have you back again today. Hedley, how are you going?
I'm good, Chair. Thank you. That's very flattering of you as well. I appreciate you saying that. I hope I can live up to a part of that.
Thank you. Well, look, we're not even out of Q1 of 2026, and this year has thrown more at our investors than most years, like combined in its entirety. I don't want to be a doomsayer, but I want to really recap this. Like, we have a conflict in the Middle East that's effectively closed the Strait of Hormuz and sent oil prices surging by 50% since January. We have the RBA now raising interest rates the second time consecutively this year, and last year, of course, piling in even more pressure onto Australian households that's already quite stretched. And we had gold hitting an all-time record high and then pulling back now by over 20%, and silver pulling back by over 40%. And then now, underneath all of this, whenever I speak with you, well, the last time is that you're telling me that we're only just getting started with the mining boom, which you firmly believe in. And there's now so much noise in the market. And frankly, a lot of our investors and the general marketplace is spooked. I'm spooked. So I want the signals, Hedley. I want to hear clarity from you.
Sure. Well, I think we've got a bit to work through, and your colleagues at Shares in Value have prepared some excellent slides to guide us. But I suppose I'd just sort of add my own comments to the intro here, which is that if you're a long-term investor, you look at long-term themes, and we've had a number of oil crises, conflicts, sometimes the two taking place, in the same space and time over time. I don't think that you could say that from a mining investor's point of view that any of those have been turning points. Rather, I think, and from the perspective of the mining boom and the mining cycle, that's something that takes place over a long period of time now. Oil price will influence costs, but it's not going to take away the fundamental drivers which have started that and will cause it to take place over time. And so long as this event doesn't take us well off the rails, and I don't want to talk about World War III. I think that's a long way out of consideration yet, and I'm not a military strategist, but we're talking about a conflict in the Middle East at this stage. And whilst that's the case, this is something which should not interrupt that programming for a long period of time. And now, I'm not making light of the human aspect of that. It's absolutely awful. The way the market tends to look at these things is it starts off as a crisis and it becomes a conflict after that. At the moment, we're seeing the things which would normally play out in the Situation Room in the White House or over those red telephones that you see on TV. We're seeing that in the media. It should be more private than that. And it seems like it's getting worse every time the media reports it. But many of these things have happened before, or shades of them. So I think we've got to view it through that prism for now. And the way that I sit back and think of it is, okay, this is going to lead to short-term volatility, but probably not a turning point.
Sure. And look, I want to make a quick disclaimer because today is actually the Monday, the 23rd of March. We are recording after the market has closed. And the reason why I want to disclose that is once we obviously finish this interview, it will usually be released in the next 48 to 72 hours. And there could be a lag time, and so much can also change again. Right.
You can tell what day it is by the gold price we talk about, right?
Well, look, we try to be so prepared, and these slides were only done on Friday, and it's Monday, and like I woke up and I was like, "What the heck just happened?"
Well, the chart that we're looking at the moment, which is how I've been talking about the mining boom to our investors and to other people, that was probably cut. I think that chart was towards the end of February, very, very, very early March. So you actually can't see the imposition of Iran on that yet. And it takes place over a very short period of time, but both of those charts leg down. So, it's only a few weeks out of date, but it looks quite out of date when you include that part.
Now, look, in that case, let's talk to me here. Like, how does a war of this nature interact with your not your mining cycle, it's everyone's mining cycle. Does it accelerate it? Does it complicate it? Or ultimately, does the boom still continue irrespective?
Yeah. Well, Conflicts typically lead to correlations in commodity prices, much, much stronger correlations than you would see through other markets. And, the larger the conflict, the more correlated those things are. But this is also happening against the backdrop of, I suppose you'd say, deglobalization. And by that, you could just simplify it to there's going to be a market controlled by China and a market controlled by the US. And people, countries may even be polarized towards those two sides of what the market may be. Now, that's going to result in stockpiling, that's going to result in hoarding, and it's going to result in pricing that reflects those behaviours. So I think this is something which you could view through that prism. It's certainly happening against the backdrop of that, and I think you need to include the two. The other thing I would say is that conflicts in the past have disrupted many markets temporarily, and then the trend of them tends to continue on the other side. We're not in 1973 now, not yet. That was a conflict which was, the poles of the Middle East tearing it apart and OPEC nations taking control of the oil price. Those two things led to a huge uplift in the oil price and inflation running through global markets over the space of a decade. I don't think we're at the point where we can say this is going to be quite so significant. I mean, we've seen an uplift in the oil price, and that makes a great deal of sense. This is going to be a disruption that probably means that lingers for a period of time, even if it was solved right now, which I don't think it is. This doesn't look like something which is tumbling into a deeper and deeper and deeper crisis. This is something that I think the US want to disembed themselves from. We're going down a slippery slope here of me trying to guess what the US are going to do, and I should probably avoid that. But I think there's a lot of logic around that in the market, and at the moment that's what a lot of people are probably thinking about. So, if that's the case, can we frame this as something which we've seen before? It's definitely not Gulf War One. I think it is going to be crucially different from that, but it's also not 1973. And in 1973, we saw 3 to 4 times uplift in the oil price, and then that was followed by 1979, which was another 2 to 3 times uplift. It was probably overall an uplift of about circa 8 to 10 times in the oil price in the space of a decade. Now, that's probably as significant as China coming into the global markets to consume oil, which it did between 2000 and 2010. Similar magnitude uplift. One's due to consumption, one's due to supply, and we feel very differently about the both of those. But conflicts in the past, we've also seen gold behave quite strongly as a result of, and many other consumable hard commodities that go into all sorts of things, not just the economy, but also into conflict. So from a mining investor's point of view, I think this probably adds to the demand picture for a lot of those metals. It probably provides a long-term, pretty stable pricing picture. But I've got to say, we would probably both agree as well that watching it through the prism of the 23rd of March, it's pretty difficult to see through to the other side just yet. So there's obviously a lot of uncertainty about what that really plays out to mean. So I'm taking we should be right in a few months type perspective here, but not discounting that there's going to be a great deal of volatility in between times.
And in that case, let's segue into now gold, right? Look, let's look at the charts here. The numbers are quite staggering. What took the entire year of 2024 to accumulate in gold ETF inflows is now happening like every few weeks in 2026, well, originally. Western money is finally showing up to a party that the Asian and central bank buyers have been doing it for years. Now, Hedley, I know you've been a gold bull for a while, and you're heavily positioned in it, so you really walk your talk. But we've had this massive pullback, and some of our members are extremely rattled. You talked to me already. You said that you've seen cycles like this before. So is this pullback actually telling us something different, or is it something that you expected? Or is it just noise within, some bigger structural move?
All right, talk about 10 questions all in one. There's some hard hitting ones there too. So first point, gold bull is a description that I would give to someone who has a really conviction belief that the gold price is going to the moon. And I can see the fundamentals for gold. I think they're very, very strong, and I think they remain in place. I wouldn't describe myself as a gold bull, nor would I describe myself as a gold bear. I'd probably describe myself as an investor that likes to target gold opportunities because it's the easiest commodity to commercialize and it's lowest risk as far as investing goes. So that's the reason that we've held a lot of those and still do. But that plays into this slightly differently, because when the gold price goes from probably where we started on our journey of investing in the suite of assets that we've got back in 2022, we would have been talking about gold prices that were in the high thousands per ounce, sub 2,000. Now we sit in between 5 and 4,000, and we've come an awful long way from there. That's been a very, very aggressive move. And in fact, during 2025 and 26, we've seen a huge amount of, let's call it liquidity, right? Money chasing this gold. And gold responds to that, but it's been extraordinarily aggressive. Now, for the robust fundamentals of gold to play out over time, you get longevity from these cycles by them playing out gradually. And when they play out rapidly, well, you probably bring yourself closer to the end of the movement. So did we anticipate this? There's a part of the answer which is going to sound like yes, and there's a part of the answer that's going to sound like no. If we'd anticipated there was going to be a pullback that happened during March that was as violent as this, then we would have been selling in February. I think in the mining space, and particularly in the junior space, which is where a lot of shares and value investors and members are oriented, you would really struggle to pick the tops and bottoms of this volatility. And as long as you see it as the top and bottom of volatility and not an upper and lower turning point, I think holding is something that you're going to drive yourself crazy trying to go, well, should I be selling some just to pick them up later at a lower price? Particularly if we're discussing that now. I mean, there are many, many things that could happen in the next few days that bring about a bottom in this movement, in which case, do you then wait another week before you buy back in, and you'll miss a lot of the up? So I think from that perspective, this liquidity has been coming long term. It was very aggressive, particularly in early 2026. So the part of my answer, which is yes, would have anticipated this, it's more oriented towards it would be healthy to see a slowing down of that liquidity. And what it's been brought about by is a black swan event. And that's where my answer is no, didn't anticipate it, because we didn't anticipate a black swan event to be the thing that would bring that about. Rather, I would have assumed that 2026 couldn't have sustained itself to be quite so aggressive. So by the end of Q1, we might have been seeing a flattening of gold price, or even a tempering in the high fours. So as it happens, we're in the low fours. Perhaps that makes it look more like an opportunity. Clearly, geopolitical events could change that view pretty quickly, but according to normal progression and this washing out over months, I think we probably see the trend that you've got on the ETF buying here playing out longer term. I mean, what that is showing is that in 2024, US markets, European markets were kind of, we'll see how this goes. We're really not interested in gold. Most of the buying of gold, the consumption of it, was dictated by BRIC nations, central banks, not Western nations, BRIC nations. I think in 2025 was the year that Western markets, investment markets, caught up with that theme and became gold buyers. And as they added to the list of gold buyers, it added price momentum. And in 2026, that continued on. Now, that's the part which has been momentarily paused or interrupted by this. So it's going to be really interesting to see what those figures look like, not only for central bank buying, but for ETF flows in March, because I think you're going to see some really interesting behaviours from Asian markets, and that may very well be a large net inflow in the Asian markets to gold ETFs. And I think you're going to see central bank buying maintained. We're going to have to wait a little while to see what that looks like. But I think those investors had their heads very well oriented towards what they wanted to achieve and were not price sensitive. And as it appears, I mean, we're not seeing much commentary out of Asia at all on what's going on in Iran. They seem to be able to get their oil out, so they may not be as perturbed as Western investors are.
And in that case, the mystery here is, so who's doing the selling? I mean, gold's 20%. Yeah. Someone's dumping on the market.
Well, I guess you go back through events of financial dislocation and even things like the global financial crisis, which, as far as the gold bull market, which lasted from the early noughties to about 2011, that had the global financial crisis right in the middle of it. And it was it disrupted or was it just paused? I think it was probably more paused than anything. There was strong gold selling along with everything else. And the way the rhetoric goes is that the holders of gold will sell their gold because it's the most liquid thing they've got to meet their other obligations. And it might be to invest in other things that they see as cheap, or it might be because they're having redemptions in the private equity markets and need to meet a leveraged position or something like that. So, every investor that holds gold is probably going to have a slightly different sentiment around that. But I think overall, the story goes that in moments like this, gold is the most liquid thing, and it is brought to bear to meet obligations or liabilities that can't be left until later. So that's where the selling is coming from. And every institution is going to feel that a little bit differently. But I think on average, that's probably what's taking place. Where does it stop?
Mm-hmm.
When people stop worrying about what their obligations are and they start. I said before, when they shift from seeing this as a crisis to seeing it as a conflict, because I think the two are very different. Conflict can extend well into crisis, but crisis is probably that moment where what does the future look like? Nobody knows. The headlines are worse each day. As that diminishes, then there's going to be an adjustment in the way that people feel and the way that investors behave and what they're buying and what they're selling.
Sure. Now, looking back at like this chart, you can see here like the current cycle's already delivered 4.6 times. Like with the chart, therefore, I want to ask the question, what do you think the next multiple could actually look like?
The next multiple of gold price, you mean?
Yes.
Well, I suppose you kind of got to stand back from any one data series and gold price in particular. If the data series you're looking at is gold price, you've kind of got to stand back and go, okay, what has driven the up part of that cycle? Has it been permanently interrupted? My view is this is a pause, and the fundamentals of gold will, remain in place when we get to the other side of it. Now, that gold price could fall further, particularly if there's more selling to come. But on the other side of it, where do we expect that to go? Well, I don't think we've seen 5,000 for the last time. I think that's established a precedent. If this was a turning point, then we'd have to view this differently. But we are coming into a market where inflation is going to be a thing. It's going to be a much bigger thing than it was as a result of COVID stimuli and as a result of the Ukraine invasion. So let's just get used to the fact that inflation is going to be there. And that inflation is going to be a positive driver for the gold price. So I think that's an easy long distance one to make. Is it 5,000? Is it 10,000? Is it some number in between? I feel incredibly superstitious about putting numbers on it, but I've got to say that having been well over 5,000 already, that takes the precedent out of the question. So you just know that it can go back there again. And rather, probably the way I would view it is we're likely to see this chart that you've got on the screen at the moment, the central bank buying going sideways from here, as in that central bank demand will be maintained. I think it remains very robust. Those are price sensitive buyers. So they will provide support in the market without even thinking of it as support. They'll think of it as accumulating gold. And there'll be a point where other investors come back to the market as buyers and begin to accumulate gold as a hedge against inflation, and they will add to the buying pile. So we've been seeing over the past, call it 18 months, that central bank buying, which, as I said, maintained into the future, and that has had investor interest piled on top of it. And as that's happened, that's what's pushed the price. So I think you will see a resumption of gold price trajectory at some stage, and I think you will see it supersede the peaks that we have already seen. The time frame on that is a difficult one, but I think with the history of global financial crisis, the 1973 oil price event, both of those, the oil price impact and the high points of the conflict were moments in time that caused a blip, but the overall trend was something that played out over a much longer period and was resumed after the world took its eyes off the crisis and began to see it more as conflict.
Sure. So you are not a gold bull. You are superstitious.
Yes, thank you. You're pulling those ends together very nicely.
But I do want some firm answers from you. Okay, the word is not bullish. So in that case, from what I can gather, and I don't want to put words in your mouth, are you telling our investors, who obviously deeply value what you have to say, that you remain high conviction with gold? And I guess one more question. What do you have to say for investors who are a bit shaky right now on
Yep.
gold?
Okay, so I don't want to be known as a gold bull because
Yeah,
I
you
kind of
said that.
conflate that to kind of it's almost like a conspiratorial view of the world that some of these investors can develop. And I just don't want to be lumped with that because
Mhm.
I think fundamentals are what you need to follow. And gold has directional fundamentals. They're not fundamentals you can use to value it and put a price on it. It just sort of says there's going to be buying, that's going to exceed selling. And for that reason, the price is going to likely go up and be positive. So that's the way I see gold at the moment, and I see those as being fundamentals which will go into the future. So conflict in the world has always been something which has been supportive of gold. The Cold War, which extended from the end of World War II until the early 90s, sat behind some very long-term buying periods for gold. When inflation creeps in there, you bring more buyers to the market. And when you're going through an event like deglobalization and even de-dollarization, it's something none of us have ever experienced before. But that looks to be something which is driving the buying interest from many spheres that add themselves to the central bank buying. So I think those things are all very positive for gold. So I'd call myself, a conviction position on gold, which is
Mhm.
positive. None of that is conspiratorial, so I'm not telling you that they are acting. That tends to be how many sentences start with some of those, and I just separate myself from that. I don't want to discount it. I tend to think more in terms of what I can see and observe and act on. Every investor is going to feel a bit differently about this, and I suppose the first thing that I feel, and this is reflecting on Lion's portfolio, which is a bunch of stocks, many of which are gold exposed, but commodity
Mm.
exposed across the board. And we look at those and say, okay, price is falling. What do we do?
Yep.
First thing is, we feel very comfortable with the suite of assets which we're involved in. So the majority of our money is invested in a group of projects which we think are very high quality. That's why we chose them. And we think they're going to be worth holding through a cycle. So as the cycle plays out to its natural extent, those things are likely to become more valuable into the future. Second thing is we've seen such a rapid deterioration, and every single day could have been the bottom here. For us to say, let's sell them at a level and expect to come back to them, I think we probably would have been, probably kidding ourselves, probably adding to the down and then adding to the up. There's a little bit of self-fulfilling prophecy to some of that action. And largely we feel we'd be better off just holding these things because of our biggest investments, and in fact, many of our smaller ones, they're incredibly well funded, having been able to raise money over the past 12 months. So they have no need to be approaching the capital markets in the next 1 or 2 months in many cases. In which case, are they going to crystallise the prices that they're at, or are they going to trade out of these positions if markets right themselves? I think it's much more that case that's what they'll be doing. So we're not sitting there going, okay, we need to be planning a way to the exit rapidly here. The second thing I would add is that we're in a situation where we have there's a large proportion of our assets which are cash at the moment. This is where a lot of
Mm.
people will vary. So I
How
don't
much
want to.
cash?
Well, so this is the thing, right? When you have cash, you can say, okay, our perspective on the future is driven by our need for cash now. We've got a circa $40 million cash amount on our balance sheet. It's not committed to anything.
Mhm.
And it means we can think opportunistically about what's going on right now. So if opportunities present, we don't need to sell anything in order to get into those. Secondly, we don't have liabilities coming down the pathway at us that we're going to have to throw that cash at. So we're very comfortable in where we sit at the moment, and I think that enables us to think long term. That may be where a lot of investors differ. Those with cash and can feel that they're liquid at the moment are going to be able
Mm.
to look into the future and probably a little bit more circumspect about what it might mean. But I've got a lot of empathy for people, particularly investors with their own personal balance sheets, where they're thinking about grocery bills, fuel bills, etc., which are mounting up, and that's going to impinge their investing outlook. So, from that perspective, their ability to stay liquid is going to be dictated by their cost of living as much as it is by what they want to be investing in, and those are two very separate things. So, I'm thinking far more about the future as to what that cash can achieve, and I think that is adding to our positions rather than subtracting from them.
Thank you. Now, sorry, I want to come back to this. So obviously, I missed this slide and I want to come back to this slide. Is as you can see, you talked about the 70s quite a lot, and I have to confess, I wasn't born in the 70s yet.
I caught the tail end of it, Gia, so I don't think of myself as a child of the 70s. I was right at the end of that.
But that's a staggering number, right? If you really think about it, like gold 18x'd, right, in the 70s, right? And then obviously back again in, the early 2000s. And the truth is, gold only comes around every few decades. So what I'm trying to say is, we also don't want to be missing it, especially when all of the signals are pointing towards that, despite, like you said, the conflict.
Yeah. So each of those gold bull markets
Mm,
is where there was central bank buying as a feature of many of them,
yep.
particularly the 1970s bull market, and that was added to by investors that wanted gold for two reasons. First of all, it became privately ownable, so gold was floated, and the US made it privately ownable in the early 70s. And you would argue that the price people would be paying right at the start of that was less than gold was notionally worth.
Mm,
It had been capped for many, many years with an artificial pricing mechanism. So unlock that, it sets it free. It probably does start to rise. But then you've got massive inflation as a result of oil price coming on top of that. And you had central banks that, their observation of the world at that point in time or that decade was that the world is an unstable place.
mm,
Conflicts in the Middle East and a Cold War, which was, Russia versus America. There's a lot of reasons to want to have a big hedge against a variety of currencies, but also against inflation, the purchasing power of your own currency, the ability to act in currency markets. So gold had a huge importance to central banks there, and the
mm,
investors that piled on top, particularly when inflation began to bite, is what drove the gold price up. In the noughties, we were off the tail end of the gold price being suppressed by two things. It was the market selling it. So the gold industry had been hedging rampantly. And when they built up these massive hedges on their balance sheets, and all of a sudden derivatives became a no-no, and that was because of Enron.
mm,
Derivative hedges needed to be unwound, and when they were, the gold industry went from selling more gold than it was producing to buying more gold than it was able to produce to eradicate those hedges. And that happened at a time where central banks were sellers. They were sellers because the Cold War had ended. We were in this Goldilocks decade of the US having a surplus and various other things. Nothing could possibly go wrong. And central banks said, well, we don't need gold anymore. We found ourselves very quickly in a period of time after that, in 2007 and 8, after the global financial crisis, where central banks suddenly did need gold. And it wasn't because of conflict. It was because the BRIC nations decided they couldn't trust Western nations and their currencies anymore because they were committing QE rather than stomaching austerity. So it was a different breed of central banks which became buyers at that point, but they've been buyers ever since. And now we find ourselves in a market where US dollars are confiscatable as a result of the Ukraine crisis. Inflation is a thing, and that's, COVID, then Ukraine, sort of both contributed to that. And here we are with more conflict and what's happening in Iran. So I think there's a pile of very, very strong drivers there. And the central banks now seeing conflict as a reason why they want to be holding more gold, as opposed to just we're afraid of what the Western central banks might do next time there's a financial crisis. But you know what? Oil price is something it's very difficult to QE against because we're going to see inflation and not, dropping of interest rates. It's going to be interest rates probably piling up. So I think that piles up an argument for gold, which is pretty compelling. The other thing I would add is that, and I don't think you can see it on this chart because it comes from my original, but there's a faded series in the background there, which is annual global gold production.
mhm,
As each of those gold bull markets have played out, you've seen gold production spike and head up very rapidly. And when that happens, that corresponds with the end of the gold bull market. And I think the way that that plays in is that of all the ounces which are demanded every year by buyers, suddenly that demand is met. And it just enables the price to sort of be neutralized and drift away. Now,
mm.
we're in about 5 years into a flat gold market now of annual gold production. If that's the case, then I think you could probably argue that until you can see growing gold production, and I don't see it, it's as constrained as many other commodities, then there's not going to be a supply response that destroys this. And that probably keeps a tight market if the annual purchasing interest remains along the lines of what I said.
Sure. And I hope this gives a lot of our investors and our members and our viewers right now a bit of comfort to see this chart. Because what, you have said before, is that when we look at one slither of the date, right? Let's say between the beginning of this year, you only see Armageddon. But when you take your lenses out a bit further and we go back into time and we truly see what has actually happened, it's actually not as dramatic as we think it is until we look back in time. And what gives me, and the fact is, if we're only at 4.6, and out of these two particular decades we're looking at, one was 18 times and one was seven. The world is so much more conscious now. There's still so much more opportunity to run.
Yeah, absolutely. And I mean, it's like you say, Gia, when you've got a very short-term lens, it's easy to see Armageddon. But when you stand back and take a long-term perspective, and that is incredibly difficult to do as an investor, and there are a lot of people who probably think it's foolish to even suggest that, given what we're seeing in the world at the moment. I'm trying my best to see it as a long-term investor, and I think with that lens, you can see some positivity on the other side of it. The uncertainty is what happens in between.
True. Hey, I'm very excited. Let's talk about your clock.
Well, we said in our last quarterly report, which came out in February, that it was 7 o'clock, which means the boom has started. The liquidity money has been flowing into the sector through capital raisings and people buying shares. And I think that trend is still very much intact. I mean, we're going to see a pause on it, right? But I think we come out the other end of this, and people are going to still want to be investing in mining shares. They're still going to be wanting to see people raise money and for that money to be deployed in building projects and things like that. So 7 o'clock, which is what this clock says, I think is still the time call as I would make it. Now, if we hadn't had a run, let's just engage in a bit of futuristic, foolish gazing. Iran doesn't happen. Gold price keeps on marching on as it was, and liquidity behaving as it was. We might have been at 8 or 9 o'clock by Christmas, and I think that probably would have seen volatility getting well ahead of itself. So, will come a correction for some reason. And often when you have a correction for one reason or another, it brings the heat out of it, but it brings it back to the fundamental. So 7 o'clock, I think, for the foreseeable future.
Look, Australians love clock because obviously we have one for the property clock. Could you explain to us, I guess, briefly for those who are new to you, Hedley, and which once they watch this, they'll be hooked. Tell us more about the clock. Like, just explain to them, what this clock and this patent, that you and your father came up with.
Yeah, so we talk about the Lion mining clock, and it's a depiction of the boom bust cycle which takes place in mining. Now, these cycles have been happening for as long as there's been money available for people to buy mining securities. So I'm talking hundreds of years here, and you can go back through and read about gold rushes and things like that. They are equity booms as much as they were activity booms as well. The same still takes place. It's either money rushing in or making its way out of the mining sector in an investment sense that drives this. So when there's a boom on, we've got increasing amounts of money and it's coming into the market. When the bust is happening, then that's money leaving the sector. Busts typically are quite short and they can be quite sharp. 1987, 1997 was a bit more protracted, but they were still, less than a year or thereabouts. 2011 through 2015 was a much longer bust. And these things can be big or small as well. So the timeframes vary a bit, and the quantum varies a bit. But typically, you have a period of up, and that is generally speaking uninterrupted. You have volatility along the way. Good and bad things happen, but you go from a low level where the bust finishes to the top where the boom finishes. And then you have a bust where things fall away again. We're very, very early in all the signals that we see of the kinds of behaviours that help us to understand what time we are in this. And you can measure the amount of money coming in, but you can also look at the behaviours which tend to take place around this clock. And they are the things which tend to be the same every single time around. Sometimes they're more pronounced, sometimes they're less pronounced, but they always occur at the same time. So we're putting this to very early in a new boom taking place, which I think is really healthy for an investing outlook because we think there's years to play out on that. Clearly, we need to wash through the Iran situation first, but I think on the other side of that, this programming resumes.
Well, in that case, I'm just going to ask you a pun. Is your clock still on time with everything that's happening?
Well, a lot of people have questions around this, and it's sort of the same question here in that, things happen on a momentary, on a time frame of days or even months. And does that interrupt it? And people will often ask, well, is there an iron ore clock? Is there a gold clock? Is one further ahead of the other? My answer to that is no. The amount of money which is moving into the mining industry as a whole is what dictates this. And that's what will push up share prices across the board. So for the last 18 months, we've been seeing most mining commodities moving upwards. We've been seeing share prices across the board, not just gold companies, copper companies, lithium companies, nickel companies, dare I even say, we're starting to catch a bid. And for that to happen, it means that there's been a sentimental shift. People have stopped saying mining is crap and I don't want to be invested in it. And they've started saying this is where I want to get some alpha. And when people are moving into that space for that reason, if there's a disruption, particularly if it wasn't mining's fault, it wasn't because there's been a series of really poor performances on mining investments or by mining companies, they'll come back again after this. So, that clock, you can look at it from time to time and say, is it 8? Is it really 7? Or is it still 6? We're all going to waver a bit about that. So, but the benefit of this is I can tell you that when people start saying, Hedley, your clock's wrong, you know you're in a boom. It's when people don't give a crap about it at all that you know that you're in a bust. So sentimental shift, it's when people want to argue with me. And at the moment, people do. So I'm happy about that.
Good. Well, look, we obviously, as viewers, investors, we want to know that your clock is on time. And I guess just a quick note on that as well is, a lot of nations, right, are actually quite beguiled and actually almost secretly envious of the Australian economy because, we've had a record run with really no significant recessions. And I actually was very lucky to meet up with a advisor to the German Chancellery, and their conversation points were exactly the same, that they're now guiding the German government to also invest in mining and resources, and they're following very closely our superannuation system, what has brought so much prosperity to our nation as well. So just a quick one in that case here, Hedley, is as more countries obviously join in on the mining story, because fundamentally it was very Canadian and very Australian, do you think that will obviously compound to the entire mining industry?
Yeah, well, I suppose let's take a step back and say, how does the outlook for the boom that we're saying has just begun? We're probably a year and a half in. What's the outlook for that? Is it a big one? Is it a mild one? And I think those countries play a part there. There are a number of drivers which drive any cycle. Between 2000 and 2011, it was the emergence of China as a purchaser of commodities, and it drove commodity prices to new highs. It established new pricing paradigms for most mineral commodities. Between 2016 and 2021-22, we had a boom as well, but that wasn't driven by commodity prices moving to new highs. It was commodities well within their bands, not trading out of it, and it was really just a few mining companies moving from a very low price to earnings ratio to a slightly higher one, driven by muted commodity performance. There were some notable things in that time. Lithium was one of them, but lithium is a tiny little drop in the ocean compared to iron ore, aluminium, gold, copper, and oil, which are the bigger commodity markets. So let's establish an outlook from here then. We've got the likes of Germany, US, China, all wanting to establish independent supply sources for many of the things which they can see that they're dependent on. They want to stockpile. They want to have security of supply because perhaps they don't trust the global nature of the commodity market anymore, and they want to make that market a little bit more domesticated to them. So if they don't have native supply, but they're prepared to go overseas, and we're seeing a lot of sovereign nations come into the market and say we want to be involved in this somehow. So in Australia, the great example of can we fund critical minerals somehow using government balance sheets or stockpiling of commodities and things like that, so that we feel that that's a way of propping up companies or a way of establishing a surety of supply of it. That all has a very, very positive impact because it adds to demand, it duplicates demand. And I think that's something which is going to be a feature of this boom. And that's compounded because when we saw that China boom, we saw a huge amount of hubris come into the mining space, where mining executives started making decisions about investments they were making that were, oh, we'll get a return on this. Commodities will just go up forever. Mentality is quite difficult to understand now. We're a long way from it, but that was what was prevailing. And the result was that when the whole thing blew up and we got to the top of that cycle, investors kind of said, no, that's not good enough. We're leaving this sector, and we're leaving to a far greater extent than we ever have before. That then meant that investments in the future that needed to be long-minded, long-dated, things like exploration and building new mines, permitting new mines, all slowed down or stopped. So one of the things that will characterize this boom is going to be the supply pinch of ongoing normal demand, added to by some of this, whether it's stockpiling, whether it's deglobalization, or whether it's even just, critical minerals demand for new age uses, is all going to add to that demand picture. And it's going to be met by a very unwilling supply side, which is just lacking investment and needs to catch up. So I think that positions us for a very robust upside to this.
Oh, getting me excited again, Hedley.
I'm glad we got on the negatives, yeah.
Let's talk about copper, because I have been informed that you've recently taken a position in a junior copper company. So clearly you haven't lost the conviction in this metal. I mean, it's traded really well up and it's obviously had a pullback. So I want to know, how do you see copper playing out?
Yep. For the last 20 years, copper has nudged up against a line that you could draw on the copper chart, and you could probably say it's a line which was between $11,000 and $12,000 per tonne. And maybe that line edges up every so often, ever so slightly, and maybe inflated at 2 to 3% per annum to reflect some sort of demand growth. That was a price which the buyers of copper weren't prepared to push through. At that point, people who build power lines or however they deploy copper started to feel pain because of that price. They'd reached a point where they couldn't pass that price on to their consumers. So the most significant thing that's happened in copper in the last 50 years is that it pushed through 12,000, 12,500, 13,000 per tonne, moved decisively into those areas. Now, did it reach a price of a point of pain? I don't know. There's a lot of things happening in the copper market, and I think you could probably say that there was some very short-term demand which piled up. US tariffs, AI data centers wanting to corner the market for the copper that they needed for their purposes. So probably a short-term demand, and that's something that you can't pass through into 26 perhaps, or certainly not 27, 28. But what it did do was it established a new pricing level for copper, which shows that that line, which existed for 20 years, no longer exists. So we've now got a precedent for copper being higher than that. Anyone who purchased copper in that period of time, or anyone who makes power lines, has had to learn how to pass that much higher copper price onto their consumers. And I think that opens up the copper market to higher highs. I mean, what we talk about when we talk about new copper projects coming along is that we just lack incentive pricing. The copper price isn't high enough for people to go, I'm going to build a new copper mine, a big one, which takes a lot of capex, and I need to see a return. Whilst that condition doesn't exist, new copper mines won't be built. That 13,000 and whatever price for copper started to say, we're coming into a market here where that incentive price is going to be discovered. So I think that outlook is also very positive. But, copper is tight as a drum. There's a hell of a lot of demand, and the supply picture is really tight. That's not necessarily the case over all commodities. Something like lead is probably far more elastic than copper is. But copper's the big market. Copper's the economic indicator, if you like. And I think that probably says we're going to have to see higher copper prices into the future. So, get yourself ready for $15,000 a tonne. That's probably a near-term level to look for. And when we've seen copper, this is not the first time that we've seen a 20-year resistance level which has been broken. It happened in 2005 when Chinese demand pushed it through the previous demand level, and the settling level was 3 to 4 times higher than the previous 20-year resistance line. So are we going to see that kind of multiple in copper? I'm not sure yet. I just can't rule out some upside on that 13,400 or whatever the peak price was that we've seen so far. I think it could be considerably higher than that. Not, I don't think that 14,000 or 15,000 is out of the out of the question for now.
Sure. And I guess the usage for copper, we always have flavors of the month. Let's say last year or the year before, it was constantly this conversation around EV, the need for new EVs. But something that's going to stay around is the need for copper to actually construct all the AI data centers that we're going to need for the future of the world.
Yeah. Well, look, I got to say I'm not a huge fan of AI. I see its usage,
Mm-hmm,
but there's a flip side to that coin. And in the US, I think it's interesting. This conflict in Iran has kind
mm-hmm,
of superimposed itself on some negativity, which has just flown into the US market around AI. And I think the penny dropping of this could take away a lot of jobs, and it's going to consume a lot of water and power. And how does the ordinary person in the street feel about that? So it's a interesting philosophical point, but these things are progressing at haste. Data centers are being constructed, and this is an arms race for AI superiority, right? Not one of them has it at the moment. They want to leapfrog each other, and they're competing for things like which of us can be used by the US government to control defense systems. That's an enormous thing for AI, and there's a huge amount of data computing power which is required for that. So this demand picture for AI, if you say, well, it's going to result in X amount of X tons of copper that need to be purchased and put into it, you can't average that over 10 years. That's now. They need it
mm-hmm.
now. And if they
Yep.
don't get it now, they might miss out on the ascendancy and beating all of their competitors. So, and there's money being thrown at it as well. I mean, these businesses have been able to raise billions of dollars. The amount of money which has been thrown into constructing data centers makes the amount of capex which is available in the mining industry at the moment look very insignificant. So, it's fascinating. Does the mining industry club together and say, righto, these AI guys need it, so maybe we need an AI price for copper? That would be a fascinating, clearly very philosophical, right? But how would OPEC behave if it was oil going into those data centers? And you would see a very interesting pricing behavior. So, I think copper is a fascinating one, and that AI thing right now is what is spiking the price. And as
Mm-hmm.
much as that demand might not be extrapolatable into the future, there will be more data centers. Don't worry about that. But maybe not all at once. The thing is that will establish a pricing paradigm which everything else will have to conform to into the future.
So this is something that I've been meaning to talk to you about. The Strait of Hormuz situation has done something that we haven't seen in a really long time. I've never seen it in my entire lifetime. It's taken Brent crude up approximately 50% up since the start of like 2026. Oil up to $110 a barrel. So please tell me from this chart what is actually happening.
Uh, Oil price is one of those funny ones. I mean, there is a real monopoly in oil which still plays out, and the Middle East produces a lot of it. So this kind of thing hits oil really hard. Now, what's different, I suppose, to other oil crises in the past? It's interesting that the US is probably far more self-sufficient in oil and energy than it was in previous oil crises.
Mm-hmm,
Europe is probably less self-sufficient,
mm-hmm,
and there is a completely different relationship with places like Venezuela or Russia, which are other ascendant, pretty significant producers. So, there's all this geopolitics which overlay itself on oil. Supply is clearly very, very important, as is consumption. And I think the way that oil crises play out in the 2020s is going to be different to how it played out in the 1970s. So we've had oil crises in the past, and people talk about the 70s. I think it's worth refreshing your memory on that, because
mm,
this was a time when OPEC nations, and the 1973 was kind of Israel versus some of the Middle Eastern countries in terms of conflict. But what underpinned that was OPEC nations saying to the rest of the world, we're not so sure that we want to sell you this stuff for $2, $3 a barrel. We think it's worth a lot more than that. And, funnily enough, that coincided with the US dollar no longer being underpinned by gold. It was just a piece of paper that was worth what the US government said it was worth. So I don't know if those two were in any way conflated, but it went up in the first instance from about $2.50 to sort of well over 10, let's call it 12, $15 a barrel. So that's a
Hmm.
huge shock. We're up 50% now. I mean, that was a 300% lift at that point. And that was done by them saying, we're just going to withhold supply and you're going to see what happens. And then there was the Iranian Revolution in 1979, which was probably a little bit more conflict related in terms of how it interrupted supply.
Mm.
And then, of course, we had the Gulf Wars through the 90s, and they had completely different responses as well. So the ability for governments to absorb some of this and to manage the geopolitics is going to have a great deal to do with what happens on the other side of this. Now, given that it's the US and Israel which are targeting Iran, what needs to play out, clearly an observer of this could say, well, if both sides back away from each other, then this might moderate. And let's hope that that's what happens. I think we all probably understand the nature of some of the individuals involved here, and that's probably going to play it out a little bit further. But there will be a point that comes where the market can see that this supply can recommence.
Yep.
And I think from that point, we will start to see the oil price moderate and the effect that it has washing through the rest of the markets moderate as well. And that is going to be much closer than the end of the conflict. It's going to be something which is much closer where we see one side get the ascendancy there.
And look, 20% of the world's oil supply does go through the Strait of Hormuz. So my question for you now is, okay, let's say in 48 hours time or by Friday, and it's opened again, right? So it's relieving pressure, but will oil prices move back to its original, or do you think it is giving a reason for it to stay permanently elevated?
Well, I guess let's frame the question as after any destroyed infrastructure has been rebuilt and we get back to normal
Mm,
programming, is the oil price likely to be 50% of what it was before this, exactly what it was before this, or twice what
mm,
it was before this? I think there's probably a good reason to think that if the Straits of Hormuz are reopened and the infrastructure is restored, then that doesn't affect the overall supply and demand. If we see a toilet paper like effect where instead of having 20 to 30 days of supply, individual nation states start to stockpile 60 to 90 days of supply, then that's going to impinge demand for a period of time. And of course, there's everything in between. So I think the oil price needs to go up before it can come down. But
mhm,
this doesn't. I don't think this establishes a new pricing paradigm. Now, there are far better people you could ask about this. Oil is something which is probably outside the edge of my wheelhouse. But if I, just apply my own logic to it, that's the way I feel about it. Clearly you need to re-establish infrastructure to get back to that point, and that might be a significant period of time away. But we're not seeing a group of sellers say, we need you to pay far more for this and we're going to withhold it unless you do. That's not the case at the moment. And we've got a market where there are other sources of supply which could be, brought to bear to kind of moderate that, even if they do start to do that. This is far more about a physical dislocation. And when we've seen physical dislocations in the past, once they've been rectified, then economic drivers, bring us back to what it needs to be.
sure. And do you feel maybe, do you think Australia was well prepared for this, or do you think we're a bit blindsided?
I think in Australia, we have probably let go of energy policy. I don't think it's been oriented towards self-sufficiency. It's been far more oriented towards, a range of other considerations. So, yeah, it's a good question, but I suspect there's many people who are subscribers to shares in value who would applaud me saying that these clowns have lost control and been very, very irresponsible. But there's also going to be a subset of people who feel that Australia should be far more green in its energy supply as well. And I don't want to get in between those two drivers. If we look at it through the prism of how much fuel supply does Australia have, and just step away from the considerations of where we want long-term energy to be coming from,
Hmm.
to keep trucks moving right now, it doesn't matter there's no electric ones. They need to be diesel powered. So we need that now. And I think with that consideration in mind, the policy has probably been fairly short-minded. But yeah, that's probably my take on Australian politics for you.
Thank you, Hedley. Now, let's move into food. Food security in particular, right? Talk to me about it here because, food inflation, that often comes after oil prices actually rise. And if you really think about the second order consequences, there is actually a bit of opportunity here because despite all of the noise, we're always looking at what the problems are, but versus looking at some of the opportunities. Can you talk to me more about this?
Yeah, sure. Well, I suppose the thing is, right, food is intrinsic to every human. Everybody needs it. It's not like a Mercedes that you can give or take. Everybody needs food, and oil touches absolutely everything. So unless you grow the food yourself, and there are very few people who are self-sufficient as far as food goes in any economy, then you're affected by oil making its way into food prices because transportation is just a massive, massive part of that. Um, and we'll see what the spikiness of food prices could be if there's a reduction in the number of trucks, if supply issues become an issue for diesel supply in places like Australia. So, but this also plays into there are other commodities which impinge food prices as well. The price of fertilizer, which is another big commodity which comes through the Strait of Hormuz.
Mm.
And it's topical clearly because there's one of the names which I think we'll probably touch on a little bit later on, which is a fertilizer supplier hopeful. So the oil will inflate the price of these things.
Mm-hmm.
Food price inflation is unavoidable. It will affect everybody, and that will flow through economies, which will probably flow into many other things, interest rates being one of them. So and as an investor, you think about that as to how it applies itself to the different sectors of the market that you want to be in. In the commodity space, inflation typically aligns itself with commodity price inflation as well. So it's something which should feed into the cycle that we were talking about before.
Um, so food inflation is a bit of a lagging indicator, right? So all of this is happening. When can we start seeing this being passed on at the final mile for consumers?
Yeah.
And what are the signals?
How long will it lag by? Well, I
Mm,
think there's going to be opportunistic price setters that want to see that inflation excuse delivered into their margin a little bit
mhm,
earlier. And I don't think that you could say that the Australian supermarkets are going to be at all immune to that.
mhm,
But I mean, I suppose think about it in terms of how just about everybody consumes. Um, I mean, I probably fill up one of our cars once a week, right? And if someone's driving a truck in order to deliver from one place to another, they're probably going to fill that truck up either
mhm,
on that journey or the one before or the one after. So
mhm,
if fuel price goes up, then the delivery price of a shipment, which is, that's in the extent of days, that's going to happen quite quickly. Passing prices on. So it's not like you walk into a supermarket and the price of apples is dictated by forces like fuel prices. To some extent, there will be suppliers and there will be retailers that want to absorb some of that as well as pass some of that on. So, in order to keep people purchasing it, maintain their own businesses. So I think there's a fair bit of interplay in that. So again, we're sort of moving to the edge of my position of comfortability, but I think to think of food inflation as being something which will take place over a short number of months is
mhm,
pretty realistic. But then, of course, inflation tends to be measured on a backwards look of 12 months. How do prices differ between 12 months ago and now? And we've been through some pretty volatile times with pricing of many things, particularly in the Australian market. So, that might, I don't think that's going to smooth it out, but it's going to add extra volatility to the inflation perspective as well.
All right, so we're heading towards the pointy end of the conversation here, Hedley. So we're really going to talk about specifics here, some which you have a vested interest in, and some which are obviously shares and values calls. So are you ready to dive into it?
Let's go. Yep, I'm ready.
All right, so now, Brightstar. We know you have one of the leading positions in Brightstar, and we've obviously covered it across with East Coast Research as well. The truth is, its share price peaked at over 70 cents last year in the last 52 weeks, and now it's had a massive pullback to 34 cents and even more since today. We'd really love to hear from you. What do you think has actually happened, or is it just noise in the market we need to deafen out?
Yeah, so I think there's two parts to the answer, and the way I feel about any of these companies is probably going to have that two-part answer. So I often say opportunities and risk. In this case, I think it's just going to be easiest to say, do they have an asset? Is the first part of the question, because that at the end of the day, do you want to hold it? Has got to come back to do they have an asset?
Mm,
Brightstar has been building a gold production business, and they've gone about it in a way which is uncharacteristic. It's certainly not what the beaten path which most larger producers tread. And at the same time, they've been consolidating a number of other gold assets under their own banner. So I think
mm,
what that's resulted in is they've got a fantastic suite of assets. The production hub which they're building at Laverton has a fantastic outlook, pricing and profitability. So I think that probably means that they can deserve to be priced on a similar metric to several of their peers, the Meekas of this world, the New Murchisons of this world, and they're well below those levels. Now, those two companies are correcting as well. So anyone in gold has been corrected in the last 3 weeks. So part of what Brightstar is experiencing here is the volatility of the market being imposed upon them. And as gold price falls, gold equities do too. In this case, great assets, but how does the market view them, and what is the prism through which the market is viewing them? And I think having engaged in a number of instances of share issuance, either
mm,
to acquire projects and take companies over, and then to raise money, has been something which I think has probably caught a number of investors by surprise over that journey. And I'm speaking about over the last 18 months, 24 months, right? So that will still be in many people's minds. Now, they're incredibly well funded. I reckon they've probably got close to $400 million in their bank account as a result of issuing a Nordic bond, great form of funding for building a gold mine. And thank goodness they did, and a very large placement which they managed to do a few weeks ago. So with all that having cleared, they can do everything that is within their stated ambitions to the
mm,
point of becoming a gold producer. And I think they've got more money than they need to do that. So they shouldn't need to come back to the market. Doesn't matter what my logic is, and it doesn't matter what Alex's logic is, the managing director.
mm,
There has been this share issuance, and I think the best way for the market to know that that's not going to happen again is for
mm,
Brightstar to go on, build this project, and not issue any more shares in order
mm,
to get to that point. So I think there's a show me aspect to that, and I would say that's probably why Brightstar has been dealt a slightly heavier hand there than a number of others in the pre-production gold space. Now, having said that, if they've been oversold, then when this volatility ends, they may appear to be better value than some of the other things that are floating around in the market. And I would say from talking to Alex that that's definitely the way that he feels. And Alex is a very, very astute market reader. So don't be surprised if Alex gets on the front foot. He knows as well as everybody that there's no point promoting into a declining market. But as soon as that stops, you'll see that Energizer Bunny get well onto his bike and be shouting from the rooftops what a great story they have. And I would agree with him.
sure. And so, I guess being one of the bigger positions, do you remain highly convicted about this stock?
Yeah, well, look, whenever you're addressing a stock like this, like
Mm,
your opportunity to act is dictated by the price that you see in the market. So if Brightstar was sitting at 75 cents now above its all-time high and everything else was falling, I'd be wondering why.
mm,
Brightstar holders might be going, well, it's justified because you've got a good asset. But when you look at the price and think, well, we're in the 30s, where is this going to go? By the time you start to see value in a stock, and bearing in mind we don't know what the gold price is going to be that they're delivering into when they finish this mine in 12 months' time, we're in a situation where we wonder, would we be getting a terrible price if we sold now? So I think our
mm,
view is that as things normalise, we're going to have to take a longer term view of gold price. If we're not taking a longer term view of gold price, then we might as well just sell everything that we've got. So, our conviction is that we're going to be seeing better than current gold prices as the things in our portfolio become producers. Brightstar is one which has a very, very strong case on that basis. They can build something. I think they've also, probably the soft underbelly here, which Alex might not want me saying, is that they've made a number of you could call them mistakes or just things that have generated earnings.
Mm.
There's not many other aspirant gold producers that can draw on those learnings because they haven't gone through the process of operating two underground mines and developing a new open pit and a new underground mine. You go through that process, you learn some things. And to now be in the position to build a processing plant and other mines, they're going to know all that stuff. Everybody else is going to have to find that out along the way. So the way that Brightstar has capitalised themselves and prepared themselves in a funding sense for this, I think probably reflects those learnings. And as you read the study which they've got in the market, you probably need to have in the back of your mind, these guys have answered a few questions that others haven't to this point. So I remain very confident on that basis. And it's our second largest investment by
Hmm.
dollars applied, invested, and it remains that way. I don't think we're in the market at the moment for deploying cash into things. We'll wait and see how they settle. Brightstar doesn't need to raise cash, so there's probably not going to be as much of an opportunity for us to be injecting new cash into it. But if someone approached us and said, "Hey, I've got a percentage position in Brightstar, I want to get out, maybe I prefer to swap into your stock," I'd be happy to build the position in Brightstar if there was another way to do it. So yeah, we're constructive on that stock by a long way.
Thank you, Hedley. Those are wonderful words. Now, look, let's talk about Caspian here. They're primarily tin, and what a lot of people forget is that tin is the glue that holds the copper together, right? So,
That's it.
and the last time I believe I spoke to another CEO around tin, my memory wasn't it nearly like $50,000 per ton?
Yeah, tin price has been hitting some wonderful highs, and I mean,
Hmm.
if you go into a market information service like an Iris or a Bloomberg, you can probably get tin price back to about 1980. If you overlay that on the copper price, you're going to see shapes which are very, very, very similar. So where copper goes, you'll probably find that tin either gets there first or gets there second, but it's going to get there in a similar sort of shape chart. Tin is typically more valuable than copper, but the two curves look very, very similar. So yeah, what we were talking about before in terms of copper, the fundamental is going to translate its way into tin. Being a smaller market, new mines have a bigger input or impact on how supply will impinge the existing demand, which makes it a bit more volatile.
Hmm.
The two biggest surprises which we've had in terms of supply coming to market is the discovery of a very rich tin project in the DRC years ago now, and as that's come online, it's added supply. But you don't find projects like that every day. I think that's a very, very surprising discovery.
Mm.
And before that, it was the opening of Myanmar. There was some very rich,
Yep.
close to surface tin deposits which were discovered on the border with China. I think the surprise is that has washed right through. So, that goes to being a very tightly strong market again, much like copper.
But you obviously talked about the Democratic Republic of Congo and Myanmar, and we know both of those locations geographically are not as ideal as obviously in Western Australia or across Australia. And
Yep.
Caspian, do you think it's undervalued at the moment then, based on those
Look, they're
concepts?
a very small cap company. I mean, for 30 million bucks, you get an extensive land position which
Hmm.
has been dealt on in order to get into a very large, tin exploration position. This
Hmm.
hasn't been touched since the 1980s, and the reason why the previous owners dropped it was because a tin cartel had cornered the market, bought a lot of tin, and then dumped it into the market, and it wiped out that many tin producers.
Mm.
So it was dumped and forgotten about. But prior to the 1980s, these parts of New South Wales were regarded as being, very prospective for excellent quality assets, and there's been small producers in that area. So these guys are looking for things which have existed and been great projects in those previous markets. They have a starter, they have a resource, and they have an exploration target around that which they're drilling now. So when you talk about value in these things, you need to imagine what they could become, and that becomes a little bit subjective. These guys have got very good indications that they're drilling things which are going to grow,
Hmm.
and being capitalised at 30, having just raised some money as well. I
Sure.
think positions them exceptionally strongly. So these guys aren't going to have to raise money in the next few months. They've done that. They can push aggressively through 2026, and they're adding data the whole time. So I think this project gets bigger, and for that reason, it does look like it's underpriced. You probably look at the grades of things like this resource and say 0.5%. It doesn't sound very rich. I mean, the copper equivalent there, or the gold equivalent, this is a resource which is almost at surface. It's very, very shallow. You don't need a huge amount of grade to make that work. And in a tin sense, this is a high grade deposit. So all of that reads really well to me as far as its developability. Any scale add from here makes it sweeter.
Is Caspian part of Lion Select's portfolio?
Yeah. We have a small investment in this one, and that's been oriented towards investing in a company which was small. I mean, you can't invest $5 million in a company which is capitalized at 12. So we put, I think it was $750,000 in when they were at that market cap. I think our view is that this project is likely to grow. That will benefit the economics, and for that reason, we can probably stage our investment in. Or some people talk about this as being on a conveyor. So you put a little bit on at the start of the conveyor, and as it moves along, it gets a bit more mature. You put more on as time goes on. So assuming they continue to deliver results which show that this project is expanding, then I think we have a view of that which is worth sticking around. So we'll wait and see for that.
And look, I know we're going to talk more about Lion Select Group later though, but it sounds like for any of these stocks that you have a vested interest in, you're not just interested in investing an initial lump sum, right? You're actually thinking long term, how can you further play into it?
Yep. I think everything that we invest in for the first time, we expect that we're going to be investing in again. Now, there are reasons which will crop up from time to time that stop us in our tracks, and then we have to rethink. But we go into all of our investments saying, okay, what is it now? What do the indications tell us as geologists or engineers as we assess it? What do we think that could turn into? Let's apply some sensible metrics of our own. And if that makes us want to invest, then we know that they will need to raise money again. And we do it because we feel like we're investing cheaply. Or that implies that we try to invest at discounted prices in things which are going to grow. And the two ways which companies perform strongly in share price sense in this market is if they de-risk themselves, which means that you can pay more for what they've got, and if you add to what they've got. The most powerful way of increasing the value of a model of a project isn't by increasing the metal price, it's by putting more metal in the model. So as these companies grow, they become more valuable.
Got it. Now we're going to talk about a few companies after this now, which aren't obviously in Lion Select Group's portfolio, but I'd still love your input on it.
Sure.
Look, Firefly Metals, it's actually one of the first calls that we had in 2026. Look, it's had a meaningful pullback from its high, and I guess we'd love to hear from you on the share, and particularly, it's actually bigger. The market cap's at like $1 billion, so it's actually significantly larger than the junior caps that we normally, or even micro caps that we cover. So we'd love to hear your input on this, Hedley, especially for members that have bought in and now perhaps they want to get some guidance from you.
Yeah, sure. Well, look, Firefly is a company which is run by a group of people, spearheaded by Steve Parsons, who have a very strong history of identifying projects, positioning them very strongly in the market, being able to raise money at great prices, so having wonderful access to the market and to capital, and then being able to deploy that on things that will grow. So they take a very sophisticated geological view of the assets that they decide to work on, and they've got themselves onto a copper system here, which seems to have a lot to offer. It looks like it is a large system, and it's got some great grades within it. It's in a safe part of the world, so these guys have, I think they cut their teeth in places like Africa. They came to Australia, and then they're now off in Canada. And this is a part of Canada which you're not going to have your assets stolen from you. So you can expect the market to give you a reward when something good happens. They position themselves in copper with a bit of gold. So this is something that they envisage being able to build. Now, I haven't updated myself on the size of the resource, but these guys are still drilling it. They're still growing it. And they're building the story around what's this going to look like. I think there wouldn't be a single person that looks at this and doesn't think that it's going to turn into a mine. The scale of it is the question, and it looks as if they're well beyond the scale that this should be valuable. And you look at the producers in the market at the moment for copper at the similar scale that they might be able to achieve. and there's growth potential there as they de-risk this. So everything is volatile, and this has clearly been touched by the Iran crisis as well. People will sell things that are saleable to take care of their obligations. So I think Firefly's probably suffered as a result of being a liquid stock on that basis. But the benefit is they're not operating, so they're not paying to put fuel in trucks at the moment. It's going to be a long time before they are, which means that their leverage to margin contraction as a result of the way that metal prices have moved and costs have moved is nil. You've got to look into the future for what that's likely to look like. So if you're a believer in copper and you're a believer in gold, and you're on track with what we said before about the likely normalization of oil prices longer term, then Firefly is something that you've got a pretty rosy future, I think. And the benefit really is you're backing a team there that knows exactly what they're doing.
Thank you. We really needed that. Now let's talk about Minerals 260. Obviously, it's been one of our standout performers in 2026. We made the call at about 30 cents, and it's obviously 60 cents. I have to check the market since Friday. But I'd love to hear your thoughts on it, because obviously they've recently had $220 million funding from Franco-Nevada, and they've grown from a market cap of, let's say, I think like $200 million to become a unicorn now. So we'd love to hear from you about them. And their chairman is Tim Goyder.
Yeah. So, I mean, look, this is another company which has got a great access to capital because of the profile of some of the people involved. And those companies, Firefly, Minerals 260, etc., they tend to achieve the premium valuations early. Now, but these people aren't fools. They don't go looking for assets which you're just bidding up. They're working on assets which they have a high degree of belief in, and they've been shown an awful lot of things. So they can say with their hand on their heart, they've been able to choose the one that they think is the best. So this is an asset which is already very large, 4.5 million ounces of gold. It's been around for a long time. It's been trapped in Chinese ownership for over a decade, which means that as gold economics have changed over that period of time, it hasn't been developed. And the Chinese owner was happy to sell it. I think very happy to be investing their money into China and Africa rather than into Australia at this point in time. So Chinese gold miners look at the world completely different to how we do. And I think it's probably easier for them to operate elsewhere. Delivers it into the hands of Minerals 260. So well-capitalised group, well-funded. And I think that Franco package takes them to a position where they can say we can go a long way towards building this. If not, they're certainly going to de-risk it. I'm not sure they'll get into production for that amount of money, but you can never say we're funded to production. The most unlucky thing you can say in markets in gold mining. But those guys having that much funding means they're not going to be back in the market for a very long period of time. They can go about de-risking it and building.
And in the case that obviously for those who didn't buy at 30 cents, and now it's obviously doubled, do you still see, given your experience, there's still legs to run on this share?
Well, I think the perspective you need to have of de-risking of any of these is we missed it at 30 cents, but the question is there value at 60 cents? It's not, don't worry about 30 cents anymore. You need to be looking into the future. There's several things which play into that. First of all, your view of what metal prices are going to do. You're not going to invest in this space unless you have a positive view of that. The second thing is, as these things de-risk, you have more information. So they become more valuable. The value that you perceive in the background is probably growing as a result of that, either by adding ounces or making them more likely to be extracted and sold and playing into a model value. So I think, for any one of them looking into the future, particularly if they're funded to do the work and they don't need to raise money at stressed prices to do that, then there is a reason to think that they're going to be able to deliver news flow. That news flow will improve the value of the asset, and it will improve the way that the market looks at that asset. And those things are all very positive. So I think that construction, lacking what you think metal prices are going to be, and that is an obvious question mark at the moment, they are becoming more valuable into the future. And it's not just about where it started. These companies, as they're established, will promote themselves, deliver news, etc. And I think that probably will add to their value.
Thank you. Now, look, we're moving on to Fosco. This is another company I am aware that you have a vested interest in. Am I right?
We've got some of this. Yep.
And this links back to the story that we really talked about: food, inflation, fertilizer. So, can you tell us why Lion Selection Group took a position in Fosco?
Yep. This happened a long, long time ago. So this is our longest term investment in our portfolio at this stage. There's things we've invested in before this deep in history, but I think the first money that we invested went into this 2000 and something. It definitely wasn't the 2020s. This was the 2010s at some stage.
Yep.
Now, the reason that you would invest in fertilizer is a bulk commodity business, and one of the three big inputs to fertilizer is phosphate. There's no way you can substitute phosphate in fertilizers. So,
Okay.
if you want to invest in that thematic, you need to be getting into something that can produce phosphate. So, there are three components of fertilizers, and that phosphate is one of them. There have been some big regional suppliers, Morocco, the US,
Hmm.
and I suppose our view at the start of this was, if you want to be in the fertilizer business, you want to be in rock phosphate, then you need to be investing in big projects. There's no point going into something small here because your cost structure is going to reflect movement of bulk material. So it needs to be big. And this part of Tunisia, it's very, very similar geology to Morocco, which is where a big producing area exists. And it's always had the same potential. There is a Tunisian phosphate industry. So we know that the area was prospective, and the initial deposit here had scale to it. Now, Fosco has gone through an upheaval, which was having their access to the project blocked by a crooked local partner. That process has played out over a long period of time, and we've held our shares through that period and supported the company. We've injected people who've been most of the company from time to time. Fosco is now coming out of that. So as you shed the overlay of geopolitical risk and Tunisia having improved its legal system and many other things going right, this company is starting to hit its straps. But it has one deposit which is global scale. It's got an exploration project which probably offers the same, which means that it could be a serious player in the phosphate game. And we know that the phosphate specialists like the look of how that product looks and the likelihood of it being extracted from Tunisia. So it's a question of studies and logistics from here. I think there's no doubt over the scale and quality of the project. It's a question of how it progresses as money is added to it. And it's in a part of the world where it can put it on a boat in the Mediterranean, which is very different to the big Saudi producers now, which need to put their phosphate onto boats which need to pass through the Straits of Hormuz. So it's benefiting from the price uplift in phosphate fertilizers at the moment. That may impinge consumption because farmers need to pay that price. But when commodity price goes up, it generally plays well for producers. This company isn't a producer, but as a strategic player in the game, it's got a lot going for it.
Thank you. Now, Saturn. Okay, am I allowed to say you've been a bull on this or high conviction?
Yeah, well, we can be both. You don't have to be conspiratorial when it comes to equities. So this is our biggest investment, Gia. We've put more money into Saturn than we have anything else in our portfolio.
Okay, so
And
how
we,
do you feel? It's had a bit of a pullback, and obviously, we speak about this company very favorably every time we meet. So, what's your opinion on it right now?
yeah. Well, look, like the others that we talked about in gold, this is a gold price pullback, right? So I
Hmm.
don't think there's anyone in Brightstar or in Saturn that's selling it at the moment that's going, I never wanted to own this. I want to get out of it because the project's a heap of crap. They're getting out of it because they're saying gold is uncertain, and for that reason, I can't hold as much of this, or I want to sell it. So that's the driver. Gold price goes down, gold stocks go down. Gold price goes up, gold stocks go up. So I'm not looking at this as something which is an indication of a problem with the project. They've published economics at prices which are still below where we are. So we know they could make money from this gold project. And again, the question is what gold price is going to be prevalent when they start producing. These guys are a little bit behind Brightstar in that they've published a pre-feasibility study. The next step for them is a definitive feasibility study, and they've got money in the bank to take them through that process. So the thing that appealed to us for this is not it wasn't a play on if gold goes up, this
Mm,
stock will go up. We had that confidence, but to invest in this space, there's no point investing in things that you think are going to go up because the gold price will drive them, unless you think they're going to be a good project. Saturn have a 2 million ounce project. It's a monster, and the way that differs from everybody else's projects is instead of being a bit over here and a bit over there, and here will be an open pit, and there'll be an underground under it, and then there'll be another one over here. This is one pit. It's
mm,
one ore body, which means that you can engage all sorts of efficiencies in the way that you mine it. So that has always appealed to us, and it still does. These are very, very honest guys who are doing the assessment, and the work they've done is absolutely phenomenal. So when you see 2 million ounces in one pit that has still got growth potential, you start to wonder if they're going to be the ones that have the privilege of digging it out of the ground, because
mm.
these are the sorts of assets that a lot of bigger companies go after as well. Now, the shareholder register of Saturn, I think, is not going to be easily rolled. There's some very large holders there, but you can't discount the potential strategic interest, which just puts a tick in a box that it's an asset that should go into production and has some validity. So, yeah, it's our biggest investment, and we still have conviction on exactly why we were there.
Look, do you think there's any like potential corporate raiders during this period where pricing is a bit more volatile? Like, obviously, Saturn now presents really excellent value from the story you're telling me. Do you think it could be a potential takeover target now at this price then?
Well, when it comes to M&A, you need to think about a couple of things. The first one is the opportunity, and that's what you're asking about.
Mm,
You've always got to take a step back and say, okay, well, if someone wants to take over a company, who are they going to have to deal with? And the first line is management and the board, and
mm-hmm.
then it's a question about shareholders. And if a company has, let's say there's 100 shareholders in a company and they all hold 1% each,
Yep.
it's management that you're having the discussion with, because there's no one shareholder there which can sort of sway it or dig their heels in and be defensive. In Saturn, there is Dundee out of Canada holds, I think they're at about 18 or 19%.
Mm-hmm.
There's ourselves at 13.5%. There's Franklin Templeton that's got a large position, and there's a prospector called Josh Pitt who's also got quite a large position as well. So I think there would be a board there which would look to its register and say, okay, what do these people feel about any approach, and how are we going to deal with that going forwards? And it's a very different situation to if you've just got 1% and 2% holders on a register. You can lose control of M&A if you're not careful, and the 1% and 2% register positions are the ones that can be the most difficult sometimes, because you've got 100 different opinions, which also drive that outcome process. So I think to answer your question, I'd have to do it in two ways. First of all, I think a 2 million ounce deposit definitely has strategic interest, and
Yep.
all of the potential buyers are far better cashed up than they were last time gold was at $4,300 an ounce US.
Yep.
So, if they have growth interest, now is an opportunistic time to act. And I think there's a number of things which could come onto their menu there. Saturn might be one of them. I think they'll be assessing all of those things on the strategic value of the asset, and how they would go about getting their hands on it as well.
Thank you, Hedley. Finally, we are at Stellar Resources. Now, it currently has it is Australia's largest, I believe, no, highest grade undeveloped tin mine, and the world's third largest. So everyone is talking about potential M&A here. So can I get your opinion on Stellar? And obviously it's a tin mine, so I'd love to hear.
Yeah, sure. I don't want to sound unkind here. Mark Connolly is the chairman of this company, and he knows that I really like giving him a bit of a tease. So I do that
Say
in
hi,
very
Mark.
good nature. I do this in very good nature. Mark is an extremely objective person when he sits on boards, and I think he offers great value by doing this, because he knows that to develop an asset, you need to raise money. To do that, you need to engage in a great deal of uncertainty, and then you need to go and build it, and things can go wrong. So if there's an opportunity to sell something at a good price, I think you would see Mark sitting there going, this is great business and we should be doing it. So should an offer come along, I think that it will be dealt with in the best possible way. He's not the one driving this. There's a couple of other people on the board there who I think have great validity in that space as well, and they are great strategists. Now, we don't hold Stellar, so if I start espousing about their virtues, I think very highly of the people.
Mm.
This is a tin asset, being underground, has a higher development capital intensity than something which is shallow. And you need to develop your own plant. So, what's your process solution is always a question. And if you add the capex of going underground, then that adds a bit of stress and funding requirement. They look like they're doing deals in Tasmania to get access to former process sites. So there's one just around the corner from them called Avebury. It's had a checkered history as a nickel mine. I don't think they're interested in the nickel. They're interested in the ability to use the established process infrastructure which is there, and that means you reduce the barrier to entry for them. So I think they're making great decisions there. It says to anyone who might want to buy them, well, we might have access to a mill, so you're just going to have to make your mind up what you're going to do. There was an interview between an executive director of Metals X, which is the owner of the Renison tin mine, and I would argue the logical owner of these deposits, months ago now, sometime during last year, and money of mine. So they interviewed him and they talked about Stella, and his comment at the time was, there's surely a sensible deal that could be done here. Now, I don't know what a sensible deal looks like, but when I see companies going through the process of saying, we're not going to wait for you, we're going to find a process site so that we can do this ourselves if we have to, it says that they are showing the world that they don't need to be taken over. They've got the two options. And that's the most powerful perspective that you can put as a company. If you want to get taken over or you don't, having two potential pathways means you're not wedded to either of them. And that provides a great deal of versatility. So I think that's a great outcome. For me, looking at a company like this, I want to look at growth. Can they deliver a doubling of resource? I think in this case, you have to say that's going to be very expensive. So what you're looking at for price growth is an M&A style takeover, or do they de-risk themselves by going down the production pathway? And that doesn't have quite the multiple which we look for in some of our investments. We're prepared to take more risk on to do it, like a Caspian, and we started in that a lower market cap. So, we were looking at Caspian when it was 12 versus I think this was 70 or 75 at the same time. So, Stella has a different outlook and perhaps there's less risk associated with it. We know they've got this ore body and it's bigger and higher grade. The outcome from here might be speculating a little bit on M&A. So, two very different sets of considerations there.
Thank you. Now, look, Hedley, I want to spend the last 10 minutes talking to you about your company, your fund that you head up, obviously. Since January 2022, you've delivered 149% performance and you've paid dividends along the way. You're currently sitting on $41 million in cash. Is that still the right number, Hedley?
Yep. Yeah, the cash number's right. I think the performance has probably come down a bit over the last few days, but that's basically the performance of the money that we've invested since 2022. So yeah, those factoids are all still there. I think the end of March performance figures are probably going to see some damage from the way the market's performed. But like I said, we love the assets and we'll stick with those by and large to see them go into the future.
So talk to me about, obviously, you've got your track record. What is the opportunity here for the members and our viewers if they decide that right now it's too much volatility, they don't want to speculate on, singular stocks, but now they have the option of going into Lion Selection Group. Talk to me about the opportunity there.
Well, it's very kind of you to put it like that, Gia, because I know that if I sort of couched it like that, it might seem overly promotional on the back end of something which is a fantastic discussion of the market. So what Lion has always existed for is to maintain a professional mining investment team which is looking into the junior end of the market, which if you want to invest in the mining space, you may also want to invest in this space because it's part of mining and it offers phenomenal growth upside, which you can access from discoveries or, bringing projects to market and building them properly. If you want to get access to that growth, the question is, do you want to do it yourself? And for a lot of people, the answer to that is no, or it's not really. So they'd like to invest in a few things, but they also want sort of a multi-purpose fix that does that for them, and that's what Lion offers. So, you've got to look at this space and understand what some of the foibles are. It's incredibly volatile. You need to have a long-term view and you need to understand whether is the market coming or is the market going? Because if you've got a great view of a stock, but you happen to invest in it at the peak of a boom, your investing experience is going to be very, very different than if you invest just as bust is turning into boom. So, you can see what sort of growth you can obtain just through that in terms of the uplift that we'd had across the portfolio, which we've established already. But to do this, you're looking into a space where there's 700 or 800 listed companies that you can choose from. And if you're doing one or two of them because you've seen 4 or 5, how do you know you're even doing the better ones? So, we have thousands of meetings in a year. So we know what a good opportunity looks like because we're comparing everything we see to everything else we see. We know a lot about the people that we're meeting with, and that's a huge part of the outcome here. If there are people that say the right things to attract attention to themselves, but you need to know a bit about their track record and be able to delve into that and understand whether it's good or bad. In many cases, we know these people on whether it's we know them directly or they're only a once removed relationship. So we've got access to a lot of intelligence there across the space, and that's a big part of the decision. But then the back end of our investing process is pretty mechanical. We value the stocks and we're looking to get 10 times upside from our entry price. If we can't see that, we won't make an investment decision. We'll stand back. And we also want to avoid all the risks which are going to potentially put you out of business along the way. So in this project, can you see a product that you can sell? Sometimes that's not the case. So you'd be surprised how many projects you look at and you go, well, I can see there's lithium there, but I'm not convinced you're going to be able to generate a product you can sell. And there's the question of metal price or commodity price going into the future as well. Generally, we feel if you're investing at the start of a cycle, you're exposing yourself to the normal running of a cycle, in which case commodity prices will generally improve. So that risk assessment is more about a project working than it is about commodity price, but all commodities have a different level of risk as well.
Thank you. I have one more sticky question for you, Hedley, because obviously I like to challenge you.
Go for it.
Okay, so let's say tomorrow or even in 1 week's time, if suddenly Trump and Netanyahu decide a ceasefire with Iran, right? Because we can't avoid it. It's in the headlines. It's everywhere, right? Most people will assume that things will return to normal, but they forget, because I don't want an easy answer to a very complex question. What can you see being the second and the third order consequences that we can't see because we're not you? And how's that going to impact still the clock that we talk about?
Yep. Well, first of all, we talked about oil price potentially returning to something that resembles current or, a month ago's supply and demand as the world resumes normal programming. That will take time, but there is going to be a period of time in the middle where oil price is elevated, and that is going to mean higher costs to all energy consumers. And, there's renewables used in mining, but there is a huge impost of diesel in that time as well. And that's going to mean that margins are shrunk, particularly in the early start of the cycle. So we've had a cycle start. We've seen a very, very aggressive injection of liquidity into it, and that's been driven by the gold price. And now we've seen all that heat taken away. So I suppose one second order effect is that whilst that longer term opportunity is maintained, it's like this is a second bite at the cherry, and this is another opportunity to be putting money into the space. Now, I think people need to be very, very careful and circumspect about that, because if I had $100 to invest right now, I'd be holding that back for a gradual entry. I certainly wouldn't be saying right now is the best possible time to do it. I think this is, of any time, a time where you need to be staging your way in. Another second order effect is going to be that, or third order effect, as interest rates go up, and they're going to have to, because this isn't a COVID imposition where you can apply QE and reduce the cost of this to the general population by, growing a sovereign balance sheet. This is a time where something which affects the price of just about everything is going up. Inflation will flow across the economy. That's going to cause some people to pull back from spending, but it's going to push up interest rates, which means that the return on cash, the ability to take risk or the need to take risk, is also going to be affected. So I think that probably means that there's a rockier period ahead for small caps. And we've spoken about a lot of small caps there. Companies that have access to the capital markets, and we described a couple there, In fact, I think you could probably consider that the likes of Brightstar, Saturn, Firefly, MI6, they've got great access to the capital markets. They're big enough companies now to be able to raise money to go on with what they're doing.
Mm,
If you're a producer, in fact, I think, the likes of Evolution have come back even more heavily than some of the gold aspirants, because they are seeing their margins shrunk as we stand. They are operating, spending money on diesel and selling gold at a depressed price. So, the way that affects Evolution is slightly different to the way that it affects Saturn, for example. So I think that is an effect which is going to see a different treatment of companies. Access to capital is one thing. How it affects your margin right now is another. And how well funded you are going into the future. So if I was a gold company executing a PFS right now, I'd say, right, I'm not stressed because I'm not in production, but I do need to raise money and I do need to fund myself. So if I've got $5 million, I'm stressed. If I've got $50 million, I'm not stressed. I can wear this for a period of time. So I think there's a couple of considerations there which are going to come into the market and affect the way that companies trade as people come to grips with some of those things as well.
sure. Thank you so much, Hedley. I think we broke our record.
I think we've smashed our record. This is an all-time high, Gia. Our index of how long do we talk for is is
I've
going to,
been,
we might be in the foothills of the boom, but if we do an interview at the peak of this boom, we're going to need about 9 hours, I reckon.
I'm in. I'll bring a Sarah pack. I'll bring some rations. But what I'm going to do now, Hedley, look, I know some of our investors, our members, and our viewers already email you directly, but I want to put it back out there. If anybody has any questions, any concerns, or anything they just want to run it past, please email us info@sharesinvalue.com.au. And what we'll do, Hedley, is that we'll forward them through to you. And then I know you actually personally respond to people. So I just want to put it out there, guys. Any questions, email us, info@sharesinvalue.com.au, and Hedley and himself will respond.
Yep, there's no AI involved in any of that.
Thank you.
I got a little bit of a personal mission there that years ago I started responding to investor inquiries. There weren't very many of them, maybe one a month if I was really lucky. And I think the most respectful thing you can do when someone asks a question is to answer it rather than just go, well, they're not important enough or I don't have time. I do have time. I've got more than enough time for people who've got an interest in our business. And particularly if they're inquiring through Shares in Value, either I'll bundle up the responses and send them to you guys and you can distribute them, or if there's an email address which is appended to it, I will just go straight back to them. So I'll be more than happy to hear those questions, particularly if anything from this isn't clear, or send through alternate points of view as well. Just make sure there's a question mark in there if you want an email back.
Thank you so much, Hedley. We will probably see you in another 3 months, and let's see how the world will look like at that point.
Yeah, let's all keep our fingers crossed because we can't forget the personal side of this. There's some people suffering at the moment, and we talk about it in an investment sense, but it'd be pretty horrible being in that part of the world right now. So I look forward to talking to you then, Gia, and hopefully a lot of this is in the rearview mirror.
Thank you so much, Hedley.
It's been great to chat.